a young man, don't be lost by his hair, a young man who sits down in the Western Cape and puts it all together and has brought us here today. It's a pleasure to give the microphone to Erwin.
I agree, for Zimbabwean, no, Zambian, he's not bad, huh? Right, I'm afraid I'm going to repeat the revision, and here we are. As I always say when introducing a presentation, you can't see the property market in isolation, it's obviously part of the world market. So let's just revisit the world market. It was done by Etienne this morning. The developed world must deleverage. He didn't use that word, but they didn't cover that, but take it from me. The developed world is, they must deleverage. We've been living, and when I say we, I mean the developed world, including South Africa, living beyond our means for many, many years. And one of the graphs of Etienne showed that this morning. He said since 1995, you might recall that graph, GDP was much lower than GDE, gross domestic expenditure, right? So that's the sign that we as South Africans have been living beyond our means. So a correction must come. And on top of that, unfortunately, in the process, we created expectations which cannot be met. So that's why you see these lines in the streets all the time. Right, all this can take a very long time. So all the economists can say, and I've never called myself an economist, as a property economist, all I can say to you is we are overvalued or we're undervalued, but to call the turning point is always impossible. Right, so what does it mean for South Africa? It means per force, lower growth in the wake of the low world growth. We saw that this morning in Etienne's presentation. Our biggest export market is Europe, and Europe is facing very serious long-term adjustment problems. Right, and then of course we shot ourselves in the foot with Eskom debacle. I didn't expand on that, you understand completely what I mean by that. And because the economy is slowing down so sharply, it does mean that the fiscus, which is the fancy word for the National Treasury, they are under serious pressure, but serious pressure. And you would expect taxes and tariffs to rise to pay for all these backlogs of infrastructure. And if they're not going to rise, then the problem will be even worse in a year from now. So all this means that the consumer is continuing to be, will be continuing to be in serious trouble. And that, of course, has got important implications directly for shopping centre owners, not so shopping centre landlords. Over the past 40 years, shopping centres were the best property sector to have invested in. And they will probably be in future as well, but I think in the shorter term, shopping centres are under serious pressure because of the disposable incomes that are under pressure. Right, normally I don't quote other people because it's a sign that you don't know yourself, but I was going to make an exception here. I would like to quote Chris Hart here. You can read it for yourself, but what he's saying is exactly what I can say now. The clear-based consumption-led growth model has reached a dead end. Don't forget, I think the point was made by Etienne this morning too, that about 68% of GDP is through consumption in South Africa. Right, so right, every 6 months, Wood and Associates, we do a survey amongst some of the top economists in South Africa, and we ask them for their 5-year forecast of things like GDP and interest rates and so on. And what you see there is the latest forecast as of June 2014. And I can tell you, you haven't seen last year's, the year before's forecast, but they've come down quite drastically. I still think this might be on the optimistic side. So because of that, for the past 2 years, we've also had an alternative scenario under which the GDP grows only at 2% per annum. And I'm going to show you today what the effect of that would be on the property market. Right, first, a little bit of timing. property cycle is very long. It's about 15 to 20 years. And that's got important implications, of course, practical implications. Inter alia, it means that in your working life you've got twice the opportunity to buy cheaply, but you've got twice the opportunity to buy expensively. Right, and this is the controversial one. What drives property prices in the long term? By property, I mean not just residential, but for the sake of argument, let's make believe this is residential. How prices relate to replacement costs. If you come to think of it in the long run, Volkswagen can't sell their motor cars for less than what it cost them to manufacture the motor car outside. Applying that logic to property, you can see my logic, not so. So in the long run, the driver of house prices, of any property in fact, is the replacement cost, building cost. But it's not as simple as that. On top of that, any individual property ages. Like we all age, like everything in this universe house ages, even including the universe. So if you look at an individual property, then because of this, one step back. Construction costs, building costs, are in the long run well correlated with normal consumer prices, what we call inflation in general, right? But in the shorter term, when building contractors are under pressure, they cut their profit margins, and therefore building costs they would even go negative. Right. So because of this correlation between inflation and building costs, you would expect in the long run house prices to keep up with inflation. As I said, because of aging, it doesn't happen, not to an individual property. What you're looking at here, on these two graphs, well, let's first of all concentrate on the top graph. What you're looking at is a situation where you are holding a portfolio of properties, and the portfolio of properties, you keep on selling off older properties, or you spend a hell of a lot of money in refurbishing that portfolio. You're buying in new properties all the time, right? So you're keeping up the general quality of the portfolio. It's a bit unnatural, but this is what in fact happens to institutional portfolio. Right. Now the second graph is the first graph, but what we're doing here is we take that oscillating rental, right? That oscillating rental, we take that and we divide it by the long-term trend line, which is building cost. In other words, as economists would say, we inflate it, and then of course you get the bottom graph, or classic wave, or classic cycle. As I said, a cycle is about 15 to 20 years. Just in South Africa, in many countries, it's been shown to be the case. I only recently picked up a book from a UK academic. He researched the construction industry in the UK going back now 200 years. And guess what? He came to the same conclusion that the construction industry in the UK has, on average, a cycle of 15 to 20 years. And of course, if you come to think of it, if the construction has a 15 to 20 year cycle, what comes first, construction or property? Any guesses here? What comes first, property or construction? Property, of course, correct. So when you have a property cycle, it's only natural to expect that the construction cycle will follow suit. Right. The other thing to check out at the in the bottom graph is that it moves sideways over time in real terms, right? This is now the real cycle. It moves sideways. In other words, it's not growing faster than inflation. Very important implication of that. So if you're only dependent on capital growth, don't expect even a portfolio which stays prime through very expensive refurbishment. Even in that case, you don't expect a static portfolio to grow in the long run faster than inflation. That's the implication of what you're seeing there. Good, that's the theory. Now let's look at what happened in practice in South Africa. What you're looking at here is we're comparing real office rentals in Joburg going back to 1940. I think that is 1960. Yeah. And compared with real house prices nationally, going back to 1967, that's the earliest data we have thanks to APSA. And when I say real, we deflated the data using the BR building cost index, and that index does include the cycle because, yeah, good. And you'll notice that house prices and office rentals were moving more or less in synchrony over a very long time. You will also notice the very long cycle. You've got the bottom in 1960, another bottom in 1977, another bottom in, depending on, well, sort of a bottom in 1995. And then in 2000, the two parted company. Right? Something happened here. The question is what? My theory is that you'll see the blue line is house prices. And my theory is that house prices kept on rising because that's when we got inflation under control, interest rates came down, structurally interest rates came down, and that of course lit the fire under house prices. Right? And at the same time we moved into the new South Africa, hunky-dory, and so forth, and so on. Very high expectations and limited supply, and so that's where we had that exuberant era of irrational growth, exactly as America, and I'll show you in a moment. We'll compare the two. As opposed to what happened to office rentals at that, during that period, office rentals performed very poorly because of supply and demand factors. The point is that you could expect in time that gap to close. And the question is, what is going to happen? Is the bottom one going to come down, and or is the bottom one going to rise? Included in that graph is our forecast using our econometric model. And the first thing you will notice is that we're forecasting that in the real terms, these guys in the real terms, we're forecasting that the house prices will keep on declining. Right? It's not a crash, it's a slow decline, it's like an aeroplane making itself ready to come and land. At the same time, we do not see within the next 5 years much growth in the real terms in office rentals because of a very poor economy and oversupply that we have already in place. Right. You'll also notice, this is empirical evidence, that in the real terms, prices are moving and rentals are moving horizontally. Right. Just in case you were worrying that where do I get this idea from the long cycle, what I'm showing you here is, and I promised Dolf de Roos sitting in the back there, I'll show you today for his pleasure. Dolf's family comes from the Netherlands. They've come of Nederlands. What you're looking at is real house prices in the most posh street in Amsterdam, to the Herengracht. As you notice, that Herengracht is spelled with only one E, the first syllable, as opposed to the Herengracht in Cape Town, which we still spell in the old way with double E. The reason is the Dutch had a spelling before the early 1900s, and we didn't, of course, incorporate that into our Herengracht. What you're looking at is the real house prices going back to 1628, guys, 1628, just get it into your head. That is a few decades before Jan van Riebeeck landed here. And it goes up to 2008, that spike. Unfortunately, we don't have data for after 2008, but I'll bet my bottom dollar that thereafter it collapsed in real terms. You'll see this very long cycle, or cycles within cycles. In fact, you can read the Dutch economy, the history of the Dutch economy. You're going to read through this by studying this graph. Notice this very long, deep trough we had after the Napoleonic Wars. The trough was reached in 1828, thereabouts. Anyway, that's just from a different interest. Real United States home values. You'll notice in the United States, we've got data there going back to 1950, up to 2013. And please, this is real, so we've deflated it using the CPI of the United States, of course. And you'll notice that on this graph, real house prices moved within a narrow band of 80 to 100 on that scale, all the way from 1950s. And then something happened in the early 2000s. Real house prices shot through the roof, just kept on growing crazy. And that's, of course, what has created this opportunity now for the Gulf terrorists of this world to buy up cheap houses in the US of A. What I'm trying to say is that a blind man with a white stick would have seen that house prices were overvalued by the year 2007, right? It was so obvious. Why? Because of the substitution principle. Who in his right mind would buy a house for 110 rands if you could have it built for 100 rands? So therefore, construction cost is your underlying long-term trend line for house prices, right? And that goes for all property, by the way. Now just compare with South Africa's house prices. We followed a very similar pattern, except that our trough in the late 80s, early 90s was worse, much worse than in the United States because of our transition from apartheid to the new South Africa, and also because of very high interest rates to combat inflation at that stage, right? From 1989 onwards. And then, of course, we also had this very irrational boom period thereafter, even worse so than the Americans, by the way. But you'll notice we haven't had the correction that the Americans have had. Let me go back to the Americans. Oops, where are they now? You can see they've had a huge correction. You can argue maybe they'll have more, but that's uncertain. But they've certainly come down to below their trend line. Whereas South Africa, we're still well above our trend line. Right, which brings me to returns. Does this former, what I've shown you until now, does this mean that a house is a poor investment? Does this mean that houses are not inflation beating as the investment? The answer is fortunately no, otherwise you would have flocked out of this auditorium hereafter. What I'm showing you here is a very unique few slides. You will find it nowhere else. The first slide compares listed funds total returns in South Africa, in other words, what the Americans call REITs, and what we'll also soon call REITs. And you'll see here that I'm taking it over more or less a cycle from 1995 to 2030, a very long cycle. This is the danger, by the way. Once you know that property got a long cycle, you can prove anything by choosing your period over which you measure something, right? It's the oldest thing in the world, mostly because of ignorance. But the smart guys do it because they are smart. So I tried to choose more or less a cycle here, and you'll see amazingly a real total return of 15%. That's the Delamar percentage over that period. Now 50% in real terms is huge, as you could imagine, but it was exceptional, as you'll see in a moment. It was exceptional because the last 20 years were exceptional in our economy, not only in our economy, in the developed world's economy. In fact, even more so, even in China it was exceptional. In China they haven't had a boom like that in 500 years. So, and that, by the way, was a contributing factor to all the problems we have in the US and other places. But that's another story. Sorry guys, I'm recovering from a flu ago. So I've got to keep my distance from you. Just to refresh your memory, total return means it's the sum of the income yield plus the capital appreciation, right? So when I say 15% capital yield, it probably means that the income yield was about half of that over this period, so, right? More or less. Right. What you're now looking at is unlisted portfolios of property in South Africa over 3 cycles. The first cycle is from 1962 to 1977. That's a 16-year cycle. The next one is 77 to 95, 19-year cycle. And the last one is from 95 to 13. And these are unlisted properties, so they're directly held. And they are typical institutionally held portfolios, right? Now, most of the time, until about 15, 20 years ago, institutions in South Africa had a so-called buy and hold policy. They would buy a property, like an office building in Adams Street, Cape Town, for instance. They would buy it and they will keep it forever. I'll never forget, I was at one of these institutions 20, 30 years ago, and I said to my superior, but why don't you sell the property now? The following properties in the CBD, because we are at the top of the long cycle. That's just after I discovered the cycle. You know, his answer was, you can't sell the property because you wouldn't be able to buy it back again. Right? So at that stage, if you were a portfolio manager, what counted was the number of people reporting to you or the value of the portfolio that you were managing, not your returns. Things have changed since then. But the most important thing you can see here is that for a normal cycle, expect a total return, income yield plus capital appreciation, of about 5% real, 4 to 5%. Right? That is more or less the international rule of thumb, 4 to 5% real return. Right, something more about residential property. What you're looking at here is rental growth indexed to 2005, first quarter, and we're comparing flat rentals, growth in flat rentals since that date, with the growth in house prices, with the growth in townhouse, not prices, rentals. Note that the blue line outperformed. That is, flat rentals outperformed the rest. And my theory is that very few flats have been built in South Africa since 40 years ago. And of course, what is being built in South Africa at the moment, as the crime situation became worse and worse, is townhouses with security, of course. That explains why townhouse rentals were the worst performers over this period, because that's where all the supply was created. So, yeah. Note that for the very last year, over the past 12 months, the growth rates were only 2%, 1%, and 6%, the best one. Townhouses seem to be recovering slightly, 6%. So, in spite of the fact, and I agree with what Etienne was saying this morning, in spite of the fact that that very little supply has been added over the past number of many years, what's been happening is that because this consumer is under so much pressure, they can't really afford rental increases that are inflation beating. In fact, like I said, over the last few years, as we see here, rental increases have been far below, market rental increases have been far below inflation. Right? Now, does this mean that properties, more specifically in this case, houses, have been non-inflation beating their total returns over the past number of years? It all depends on whether you geared up when you bought that house or whether you bought it for cash. If you had geared up, it would have been a shit investment. Sorry. I've run the figures, without a doubt, very, very poor investment if you had geared up, saved 90% or 100%. If you had bought it for cash, well, you probably had an initial return of 5%, initial yield, plus capital appreciation of, say, 4%. You know, maybe you would have had a total return of 8-9%, thereabouts. Many people haven't had that sort of return. This is an example of an asset going through a difficult period. There's no such a thing that property is this magical investment. I'm sorry. It's not magical. Yes, its risk profile is lower than equity, but there's nothing magical about it. It's especially dangerous when you gear up. When you don't buy for cash, then of course you've got financial risk as well, apart from the cycle risk. I'm not going to discuss this graph. Etienne actually had the same one, except that I want to say here is that this is looking at mortgage loans, new mortgage loans and readvances deflated using the absolute home building cost index. And what you can see here is that from 1990 onwards, the number of the value of the real value and therefore the number of mortgage loans shot through the roof. And that's another indication, of course, that South Africans were sort of becoming much more risk, what's the word? Risk friendly, prepared to take risks and invest, and we were over investing in property. It's come down sharply, so I would argue that if you take the trend line from 1990 to today, then that's more or less the normal trend line that you would see in a country like South Africa, where you have new middle class people moving into the market. The other thing, of course, is that after 1994, the first 10 years or so, you had a huge immigration. Some estimates is about 1 million white South Africans left the country. So as people of color were coming into the middle class market, more or less an equal number went out. But that's now stopped. What with the Malays and the rest of the world's economies, it looks like some South Africans have come back and the immigration is largely stopped. And so we are now more or less back to a normal situation and a normal trend line. For those of you who are estate agents or are conveyancers and whose income is dependent on the number of mortgage bonds passed, we've done an exercise, and I'm just going to show you the table that shows our forecast of growth in the number of new mortgage loans. This is nominal terms, new mortgage loans and readvances for residential dwellings and flats. It's nominal, those growth rates, but check those growth rates. This year is more or less 0, next year 2.5, the year thereafter 2.5, then 5.5. In other words, it's not inflation beating, it's less than inflation. So I'm afraid this is not good news for conveyancers, transport consultants, and estate agents. Oh, yes, let's do it here too. I would like to do that. Right, so to sum up then, the medium-term prospects for house prices are as follows. Prices are still very high in the real terms, so it does mean that there's lots of scope in the real terms for house prices to slowly come down further. In other words, to have normal growth less than the inflation rate. Consumers under pressure, interest rates will rise for two reasons. The first one is Basel III, which means that in terms of Basel 2 and 3, from banks it's expected to better match their liabilities with their assets, and of course when the banks put a mortgage bond to one of us is an asset in their books, and the liability is when they take deposits, 3-month deposits from somebody else. And of course, mortgage bonds are typically 20 years in South Africa, so I don't really like it from that point of view, the matching of term. And then of course, interest rate cycle, we know that interest rates have to rise. Not by much, as we heard today from Etienne. Right. Banks are still risk averse, as they should be. Thus prices will revert to the mean in the medium term. Shopping centres, I just want to point out what this graph shows is that the consumer is under pressure. I'm not going to spend more time on it. This is an interesting one. You haven't seen this before. What we're looking at here is, from a shopping centre point of view, what historically, how have they been doing? Because the question is asked every now and then, quite correctly so, aren't we overshot as a country? And what you're looking at here is trading densities. In other words, turnovers per square meter within the shopping centres. And you're looking at it by size of shopping centre. On the left-hand side, super regionals, which are very biggest, they are more than 100,000 square meters. Then regional, then small regional, and then compared to the CPI. And these are all nominal rands. So you can see for the 10-year period, 2003 to 2013, super regional had been growing at slightly more than inflation. So that's good news. Turnovers per square meter were beating inflation. Right? And in fact, over the past year, they also beat inflation, 8.6%. But the smaller the centre, the poorer this performance has been. And that's got important implications for investment. I believe that this is a trend that's going to stay. The very big shopping centres they are so compounding that it's very difficult to take much business away from them. It does happen, and it is going to happen now with the new shopping centres here in the north of Johannesburg being built. But they are less exposed to competition than your mid-sized shopping centres. The very small ones, typically in the suburb, where you do your top-up shopping, they apparently don't do all that badly. Right, now, the problem with these shopping centres, and I can speak from experience, is that on top of the fact that their trading densities are not performing all that well, the operating costs are growing at a terrible rate. So they are in a cleft stick situation with rentals under pressure and operating costs growing very fast, much faster than inflation. And one of the important drivers of operating costs in the property sector, of course, is assessment rates. Property taxes, as Americans quite correctly call it, much better than the word rates. Now, why are assessment rates moving so fast? I recently did some original research for somebody who's going to speak on a panel in the Sakura Convention. And this is data I got from those 4 municipalities. eThekwini, Tshwane, City of Cape Town, 3 of them. And then I compare that with the consumer inflation. What you will see is over the past 10 years or so, these municipalities' salary bills have been growing at more or less double the inflation. So they've been job creators. Now, of course, this cannot go on. There's already riots, shoot. And of course, they know that they can block the non-residential landlords because they don't have the vote. It's more difficult to mock the residential landlords, the owners of houses, because they've got the vote. So that probably explains this, but I think Sakura is now kicking up so much dust. I think that this will probably come under pressure. The question, as I said before, is aren't we as a nation overshot? So I did an interesting exercise recently. What you're looking at there, the blue graph, is new shopping centres from 1960 completed. Right? And in fact, because 1960 was more or less a period when the first decentralized shopping centre was erected in this country, you're going to look at it as the beginning of our start. Square meters, measured in square meters of shopping centres, decentralized shopping centres in the country. You can see it's been growing quite strongly, as you would have expected, but it's very cyclical. And just to check our figures, we also, the broken red line is Stats SA as the source, measuring the same thing. You can see there's a high correlation. There's a lag, but the lag can be explained in that the source that we used for the blue line, in other words, it is entered in the database when the shopping centre is completed, whereas the Stats SA data come from municipalities, and they presumably wait until a occupation certificate has been issued, and when it's officially only open, but by that time, of course, we can pay as we trading for a number of months. Right. Now, what does it mean in practice? Are we overshot, yes or no? The next graph looks at the trend over a shorter period, since 1987, and you can see it grew at 2.2% per annum, the new supply of shopping space. By the way, over the longer term, we didn't calculate it. But over the shorter term, 2.2% per annum. That doesn't sound too bad. So we decided to compare it with GDP, and that's the result. From 1987 to 2013, it's a very long period, all completions grew at 2.2% per annum. Real household consumption expenditure grew at 5.4%, and real GDP at 6.5%. Now, please guys, this may sound strange to you. It's because they are the first differences. The problem is that new completions is the first difference on your stock, if you come to think of it. So we had to calculate the first differences of the GDP and the household consumption expenditure too. The point is that what this graph shows us, and what this table shows us, is that new completions have not outstripped our economy's growth rate over this period. So there isn't a serious oversupply as a generalization. But in the meantime, growth in the real retail sales have been coming down. What you're looking at here, the blue line, what you're looking at is the 4-month moving average. But in fact, the very latest figure, very latest month's figure is zero growth. So you can see a dramatic decline in the growth rate, right down to 0%, the latest figures in real terms. In other words, the number of cans being sold, if you like. Of course, sales include, retail sales, of course, include not only groceries, but also, as we heard this morning, also semi-durable and durable goods, like clothing and other products. Right, the offices market. I'm afraid there's another bad story. The red line is growth in GDP services sector. That's the guys like us who sit behind computers and we try to make everybody believe that we're actually working. And you're looking at the growth rates there, right? The red broken line. And you can see it's been coming down quite strongly. That was until very recently. It was the one sector of our economy that was holding up very well. Now it's also fallen. Very well correlated with that is the blue line, which shows the office demand. In other words, the increase in office space occupied in South Africa. And you can see that the growth in office space occupied, in other words, in demand for office space, has been in negative territory. In other words, crimping since 2008, middle of 2008, and it's still in negative territory. So don't expect any magical turnaround there, I'm afraid, before the economy, until the economy decides to recover. Good news, don't blame me, I try my best to give you a good story. Office vacancies are more or less at the long-term average, so it's not all bad news. It could have been worse. Don't blame me, I'm trying my best. I'm positive, you know, what this guy saying, positive. Right. So we're all looking for, we do, those of you who know your French literature, for something to happen. Right, nominal grade A office rentals, that's the long-term trend line. Comparing Johannesburg to Pretoria, what is noteworthy is that the red line, which is Pretoria, has been catching up since the early 90s, since 94, has been catching up with Joburg. We're talking about grade A rentals here. So we can only conclude that the news of Africa was very good to Pretoria. Pretoria is one big boom city. And of course, the explanation is very simple. There are two reasons for that. First one is the demographic shift which happened in Pretoria because of the new South Africa And secondly, of course, there's strong growth in civil servants in Pretoria. But, as I said to you in the beginning, we're going to check. Now, if given you one scenario of GDP growth, now what about the bad scenario? Let's say GDP only grows at 2% per annum for the next few years. Then you see the differences in office rental growth for the two scenarios. You can see that when GDP doesn't grow at 2.6 but only at 2, it nearly halves, more or less half the growth rates of market rentals. But even under the 2% scenario, it looks like the growth rates are still more or less close to the inflation rate. Of course, the op costs, but this story doesn't tell you is what the op costs. Right, industrial properties. Of course, the beauty of industrial properties is that they are not, they're not speculative, as opposed to office buildings, which are highly speculative, especially in the Sandton CBD at the moment. And so they tend to be more stable, and the vacancies are also under control. But you can see very little growth is left there. The latest growth figures available from the Rode surveys is plus 4% growth over the past 12 months. And then once again, the two scenarios, but this time for industrial rentals, and you can see that, of course, there's a serious impact when the GDP slows down to a 2% per annum. Listed funds. Over the past more than 10 years, 12 years or so, listed property funds in South Africa have been doing exceptionally well. Quite surprisingly, they've actually been beating normal equity. And I say surprisingly so, because you'd expect in the longer run or medium-term run, you'd expect equity to perform better than property, because the risk associated with equity is supposed to be higher, and that's the beauty of property. It is inflation beating, and at the same time, its risk profile is much lower than equities. So the question is, why on earth has REITs done so well in South Africa over the past 12 years or so? Well, after speaking to other people and applying my mind to it, I came to the following conclusions. First of all, the debt leverage, because of the low interest rates, the debt leverage has been positive. Now that can change, of course. Secondly, because of the low interest rates. Right, that's the second point. The third point is you've got a strong market rating. Once you're popular and your market rating is very strong, and your forward yield becomes very low, then of course it makes a positive gearing much more possible. Fourthly, this allowed these funds to buy directly held portfolios at earnings enhancing yields. So, for instance, to give you a practical example, you would probably buy a portfolio of prime office buildings, grade A office buildings today, at say 8.5% cap rate. Now, if it's growth point, I think their forward yield is probably 6.5%, 7% at the moment. You can see immediately it is earnings enhancing to them. And then, of course, some of the bigger funds, especially, have been investing offshore, and what with the weak rand, that has been beneficial. Big question, of course, how long can we expect this virtuous cycle to last? Right. And that, of course, intimately hangs together with prognosis for interest rates outside. Interest rates are also the fundamentals. When market rate is not growing, then, of course, things could go awry. Right. Using our consensus forecast, here's our forecast of a standing portfolio of total returns. We assume that the growth in nominal cash streams, income streams, are as per the first line. This year 6.5%, next year 7.2%, and the year thereafter 8%. And then that would do, as you could see in the second line, what it will do to prices. Giving you a total return of, well, this year very poorly, about 3% only this year total return, and next year maybe 10% again, 10, 11, 12% thereabouts and so on. Still not too bad, coming to think of it, especially if you are of the opinion that equities are overstretched at the moment. So property is not to be sneezed at. As for the low road scenario, we do the same exercise, and of course now your total returns are much lower. They'll now definitely be low double digit. They'll now be single digit total returns. Market ratings of directly held properties. It's a fancy word for capitalization rates. You can see that we had this bump in 2008 when the rest of the world also had this bump, except that ours wasn't as bad as, for instance, in America. And the reason why ours wasn't so bad is it's partially attributable to the fact that South Africa's banks have been much more conservative in lending to non-residential properties. I understand the US of A banks were quite prepared to have LTVs, loan to values, the ratios of 90%, even higher during the boom period. South Africa, our banks have, to my knowledge, never granted higher than 60% LTVs. So that gave us a cushion. Imagine what happened in America, as an example. You've got this private investor with $1 billion, say, property portfolio, highly geared, and the values start declining, so he gets a phone call from his bank and saying, sorry, but we need more equity. Right? So how does he get more equity? He starts selling his properties. That, of course, then becomes a vicious circle. Right, the good news is the market out there of directly held properties is still happy with the health of our directly held property market, and that is reflected in our capitalization rates, which are, even today, if anything else, drifting slightly lower, which of course is good news. Yeah. Conclusions? Right. With the world economy and our own infrastructure backlogs, there are constraints on South Africa's economic growth. The most serious of which, of course, is the Eskom constraint. Residential property, to my mind, is still overpriced. Sorry, guys, but I've got to tell it as it is. Which does mean that don't expect much capital growth for quite a number of years to come, despite of what happens right now as we speak. 7%, 8% growth as we speak, that is apparently being accomplished in the middle class sector of the market. My explanation for it. And after listening to Etienne this morning, he said he made the same point. It seems the banks have been relaxing their credit standards slightly, and that, of course, the credit standards is one of the factors that have been holding back house price growth. Right, office properties are fundamentally cheap, but vacancies persist. Industrial properties are fundamentally cheap. Highly indebted consumers face so-called challenges, thus more cash flows will remain under pressure, especially malls in working class locations. As Etienne was explaining so lucidly this morning, for working class people in South Africa are under huge pressure, and unfortunately they've also had very high expectations after '94, and that is not coming home to roost. Right, but property market is fundamentally healthy, and I think analysts are unreasonably pessimistic about REIM's prognosis. And that's my story.